Training. Today, we're going to have an introduction, a basics introduction for CFD training, specifically looking at Forex trading. And we have two trainers on the call. We've got Alvin. Alvin will be taking us through the basics of Forex trading. And we've got Emmanuel. Emmanuel is going to be taking us through the information around the broker that we'll be using, the licensed broker who's also a member of the Victoria Falls Stock Exchange. The broker is VCG, and Emmanuel is representing VCG. As I said, I am Edmund. I am representing Victoria Falls Stock Exchange. We are the regulator for CFDs, and our role mostly is to, number one, promote the investor education around CFDs, as well as which also includes the Forex trading. And another role that we have as the regulator is to ensure that the broker always has what we call collateral funds for all investors who will be investing on the platform. So meaning that if you then invest and put your funds on the VCG platform, it then means that you will have those funds will then be calculated exposure, and that exposure will be the amount that will keep in our trust account, just in case, God forbid, just in case if something happens to VCG and they are not able to cover the obligation towards you for your winnings, we'll simply go to that collateral account and then we'll give you the funds that are owing to you. So as the regulator, we are consistently calculating the exposure. I think Alvin will explain that further as he then explains the basics, or Emmanuel will explain that further as he explains the basics. So it means that you'll be safe on the platform. So we are just going to be there as the regulator, VFEX, to make sure that the investor is always safe. So one of the major things that we've realized that Forex trading, CFDs, is quite a new area, and a lot of people are interested in it, but yet they don't have the knowledge or the know-how on how to participate in this market. So we will continuously have different sessions once every 2 weeks, or depending on the number of people who register, we might also then have them once a week. Different sessions that will be in different series. So the next flyers we'll be seeing will be flyers that will be indicating which chapters are we going to be looking at. So if you have joined this particular meeting and Alvin takes you through chapter 1 to chapter 3, it means that the next flyer, when it comes, you see it now talking about chapter 4 to 6. Then you can then choose which session you then want to get into. So this one is going to be chapter 1 to 3, plus the basics around the broker. So thank you very much. I'm now just going to ask Emmanuel from VCG to take over and then do a presentation and also talk about what VCG is all about. Emmanuel, can you kindly take over, please?
All right. Thank you so much for the opportunity. So just want to take this time to thank you all for joining and having us on board. So let me just share my screen and I'll be able to just give you all a holistic overview of what we do and what we offer. So let me just share. All right. I hope everyone can see my screen.
Yes, yes.
All right. All right. So, first things first, we are VCG Markets. We are Vision Capital Group, a registered and fully licensed securities dealing firm. We're regulated by SECZIM and also VFX, and we're a member of VFX as well. So just to start off, we usually get a few questions pertaining to how we operate and what we offer. Sorry, I think my network is acting up. Yes, so we usually get the question, what is VCG Markets? So for that introduction, like I said, we are a member of VFX, and we are fully registered. We have many branches all over the world, but for the Zim market, we have offices at 187 Baines Avenue and 9th Street. So what do we offer? So we are just proud to let you know that we as VCG Markets, we have a new offering for the Zimbabwean market, which opens you up to a vast pool of opportunities for your managed funds. So these funds come in the form of products in various categories, such as your stocks, which are your shares, for example, your Tesla, your currencies, also known as Forex, where you can trade your pound USD. You have your precious metals, such as gold, your indices, which is your S&P 500, and you also have cryptocurrencies such as Bitcoin or Ethereum. The other question that we do usually get is why should I choose VCG markets? So we have a few benefits that we have for you to be able to trade with us. Firstly, you get to enjoy cost-effective trading, which is you will have reduced trading costs and enhanced profitability. That being, you will have zero capital gains tax. That saying is, we're just trying to say that whenever you make a withdrawal, let's say you traded on a $100 account, you made a profit of $100, making your total equity $200. Whenever you want to withdraw that $100, we will send it to you in its entirety. You will not face any charges. The only charges you will face will be with your platform, which is EcoCash or your bank. We also do offer tight spreads. We have negative balance protection. By that, we protect your funds from entering a negative balance. So in the unfortunate event that you were not implementing proper risk management and your account does blow, with some brokers, you tend to see that your balance then enters into the negative zone. But with us, your balance will just end at zero. So that whenever you want to make a deposit the next time, you will not face any challenges. You will just start from the zero balance that you would have incurred the previous time. You will have dedicated support 24 hours a day, 5 days a week. You will have cost-effective trading. We also do have a copy trading service, which is under our platform VCG Social. We shall go more into that a bit later on. And the biggest benefit that we do have is we are a member of VFX. So how to start trading with VCG markets? So we have two ways in which we can go about this. Firstly, you can just go to our website, www.vcgmarkets.com, and you would then go to the Open Live Account section. Once you click on that, you would then have this pop up. So once you then fill in your credentials, use the preferred email, and then create a password of your choice, you would then click on sign up. And I would kindly advise you that you then follow each and every single step that will follow, because you will have 5 pages of instructions. So I'd kindly ask you to follow all those instructions. That way, once you are done, your account will be verified automatically. But if you do not complete the steps, we will then have to do it manually on our end. So once you create your account, this is what your dashboard will look like. So on this dashboard, you will have your account summary. So this is where you'll be getting sort of like bank statements, so to speak, showing you the transactions, your open positions, your closed positions, your profits, your losses for that particular period. So you get statements on a daily basis, weekly basis, and also on a monthly basis. You will also have, you can see there's the deposit funds option. So on the deposit funds option, right now we are still trying to incorporate our platform's local payment options into our system. So right now we're just doing things a bit manually. So what you will then do whenever you want to make a deposit, you reach out to your account manager, because whenever you register with us, an account manager will reach out to you that very same day. So you reach out to your account manager and say that I would like to make a deposit. and your account manager will generate a link from the bank and then send it to you. And that link, once you click on that link, it will then take you to a page where you will choose between EcoCash, your Visa, MasterCard, or bank transfers. Whenever you want to make a withdrawal, you just come back to the dashboard, click on your withdraw funds option, and then you enter your details. So kindly take note that our system is designed in such a way whereby we return money to the deposit source. So if you deposited using, for instance, EcoCash, you no longer have the bank transfers and the Visa MasterCard options. You only then be able to withdraw using EcoCash. So you just fill in your details. If you used EcoCash, yes, you just use you just input your name, your phone number, and that'll be it. So now, whenever you have your account, we kindly advise clients to then, if you hadn't completed the steps when creating your dashboard, when signing up, you just click on the upload documents option. Once you upload your documents, you'll see just under your name, it will then be written verified in green. So back to VCG Social. Um, VCG Social now, this is where we have our copy trading. So with our copy trading, we have a pool of over 400 traders under our platform, international traders. So what essentially happens is once you have you've created your account with us, you then for you to register on VCG Social, you then register, you just use your credentials from the previous account. And then to link your trading account to copy trading, you then use your live trading ID that will be found on your dashboard. So once you uh, open the app, VCG Social, you then see there will be traders that will be categorized. So there's spotlight where if you click on see all the traders will be ranked from 1 up to 400 based off of their performance over a period of, let's say, 12 months. So the performance is usually highlighted in green. So with Holy Grail, he's had a return of over 8,000% from the period that he started trading with us. If you go to low drawdown, that'll be your low risk. So that's another category on its own. You'll see that the best trader right there has his own performance ratings. Under low drawdown, we have medium drawdown or medium risk. Below that, we also have high risk or high drawdown. So you then choose depending on your risk appetite, because I do believe everyone has different takes on risk. So you just choose where you're aiming for. There are people who would want to make a return in a short period of time. Those are typically categorized as high risk traders. So maybe let's say Edmond has a $100 account and then they want to spend that money in, let's say, like 2 days. You then typically go for the high risk traders. You go under that category and then you check their returns over the period they would have traded. If you're someone who is very cautious, you can go under low drawdown, where you'll be able to choose traders that suit your risk appetite. Then, so for this instance, I just chosen Holy Grail because he's the best trader that we do have. So once you click on his name, his profile will then pop up. So you will see that he has um, under copy, you will see that there is his subscription fee, the fee that he charges on overall profits made. You also see that he has over 2,000 people that are copying his account. So there's also the unrealized profit and loss and realized profit and loss. We'll go into more detail in just a bit. You'll also be able to see the leverage he's using. He uses 1:500. He also has a balance max drawdown. You'll be able to see the max loss he's incurred over his trading journey. So for him, it's 12.91% as of date. But his balance is over 28,000. So mind you, whenever you want to copy a trader, we usually advise our clients to try and match a trader's equity level, because the 12% he has on his account might not necessarily translate to your account. So for instance, Edmund has a $500 account, then he decides to then copy Holy Grail. If Holy Grail is going to have maybe say a 3% drawdown on his $20,000 account, roughly that will equate to 850 something dollars, 857 thereabouts, which is 100% drawdown on Edmund's account. So it would be advisable for clients to then choose a trader whose equity levels will be able to match. And if you scroll down on his profile, you'll be able to see his win to loss ratio. So Holy Grail has a 94% win ratio, and he's had 5% losses. If you then scroll down to, you'll be able to see on that graph, you'll be able to see the pairs he's trading. So you just click on any of the percentages shown, and you see that maybe for the green, for instance, the 34.84%, that is for pound USD. The pink one, which is your 12.55, is for Euro USD. So you'll be able to see the pairs he's trading. Now, coming back to the unrealized profit and realized profit. So as you can see, he's running a loss of about 3,000, and that's highlighted in red. So if you click on that, you'll be able to see all the open positions of all the pairs he's trading and the lot sizes he's using. If you click on realized profit, you'll be able to see all the closed positions for the particular pairs he was trading. So just to show you that, it will look like this. So for unrealized, you'll be able to see the ones in losses and the ones in profit, and the number of positions opened as well. For the realized profit, you'll be able to see all the closed positions, how much each position had at that particular point in time he was trading. And so just to finish off this presentation, I would just like to encourage our clients, just give you a quote that we use as traders, that for every trading journey begins with a single step. So for you, that first step would be understanding the markets and embracing the courage to take the risks that are associated with giving you the opportunity to grant you the gift of a skill mastery. So with that, I would like to say thank you very much. And if there are any questions, I will be free to answer them. Thank you very much.
Thank you, Emmanuel. Thank you. I think for some of you, that might have been a bit technical, but don't worry. That's why we've got Alvin here. Alvin is just going to start with the basics, and then the next time when Emmanuel then gives the same presentation, you then have an idea of what he's talking about. But in summary, you've noticed that they've shown us a copy trading platform where it gives you the ability to register on the platform, and then if you're not yet really familiar on how to trade, you can then simply select any trader there that is well versed in the trading space, and you can get to really understand or to really scrutinize his trading strategies and the amount of wins that he has done. So you can just simply put in your money and then it can then work for you. Um, so thanks for that, Emmanuel. And then he also shared the link of where you can go and register. When you register on the platform, you can always start with the demo account. And from the demo account, you can go to the live. But what Alvin is going to be doing now, Alvin is just going to give you the basics of what Forex trading is all about and some of the terminologies that are there. And then if you then continue with this series and come in the next training we're going to have, that is when he'll then start to show you logging in and how to do the technical and fundamental analysis. But thanks a lot, Emmanuel. Are there any questions before we then ask our next trainer to take over? Okay, Alvin, are you ready to take over? Um,
Uh, yes, Edmund. Can everybody hear me? Can you hear me clearly?
yeah, yeah, people can hear you. You can go ahead.
All right.
Alvin, you can take over.
All right. Thank you so much for this opportunity. Thank you so much, Mara, for that wonderful presentation. My name is Alvin, and I'm going to take you through the Forex trading or CFD presentation, just the basics. So allow me to share my screen right now. Just want you to confirm with me if you can see what I am seeing on my screen.
Okay, go ahead and share your screen. It's fine.
Can you see it yet? Before I put it into the slide.
Not yet.
Not yet. Okay. Let me just quickly do that. Window. There we go. How about now? Just want to go. Anything yet?
Hey, it's coming up now. It's just coming up.
Okay. Please just let me know if it's because I saw like a lot of people were talking about not seeing. Um.
Yeah, we can see it now.
All right. So okay. Um. So we're just gonna do an introduction to forex trading. So without further ado, we're gonna talk about we're gonna jump right into it. That's the definition. Uh, so of course, the first question is what is forex? So the main thing, or in the simplest terms that we can actually look at, the forex trading market is an international decentralized financial market whereby one currency is exchanged for another. So the forex market is the largest, most liquid market in the world, with average traded values that can be trillions of dollars per day. Yes, we're talking about trillions, not billions, but trillions of dollars. So it includes all of the currencies in the world. So the forex exchange market is often referred to as forex. I'm sure you've seen a lot of people see FX, sport FX, or plainly just sport. So historically, only large financial institutions, corporations, central banks, hedge funds, and extremely wealthy individuals had the resources to participate in the forex market. However, now, with the emergence and popularization of the internet and mainstream computing technology, it is possible for us average investors or us just retail traders to buy and sell currencies with the click of a mouse from the comfort of our home. So the factors that will affect the value of the currencies to increase or decrease are the supply and the demand of these two specific currencies that will be involved in the conversion process. I'm going to talk about the supply and demand further in the presentation. So before we go right into it, I'm just going to tell you about a little bit of the Forex history. So they started with the gold standard monetary system, which was implemented in 1876. Before the gold standard was created, countries would commonly use gold and silver, which are now the metals that we actually also trade on the forex market as a method of international payment. So a country that uses gold standard would set a fixed price for gold and buys and sells gold at that price. That fixed price is used to determine the value of the currency. So, for instance, in the era of the gold standard system before World War One, a dollar was equivalent, or they would put it up to 1 to 20 ounces of gold. So, to be more precise, it was 1 ounce,
one
1 ounce
ounce, one ounce, one ounce, one ounce, one ounce,
was $20.50. Okay, I'm getting a feedback. I don't know if it's my end. Okay. So Britain stopped using the gold standard in 1931, and the US abandoned the system in 1971. Just to go a little bit, just on the other part of the forex history, there was the Bretton Woods Agreement. So before the end of the World War II, the Allied nations believed that there would be and need to set up a new financial system. So in July 1944, 44 countries sent delegates to a conference held in Bretton Woods, New Hampshire, to deliberate over what would be called the Bretton Woods system of international monetary management. To simplify, Bretton Woods led to the formation of the following, which was a method of fixed exchange rates, which we actually have in this day and age. The US dollar replacing the gold standard to become a primary reserve currency, and the creation of two international agencies to oversee economic activity, which was the International Monetary Fund and the International Bank of Reconstruction and Development. So with that, that just basically covers just the forex history, just a bit of the forex history. So we're gonna jump into the market sessions. So I'm gonna talk about the Pacific session, which where the forex starts its working hours when the Pacific session opens on a Monday local time. This session is characterized by a rather low volatility, and as a matter of fact, this is the most peaceful time on the market. And the second session, that will be the Tokyo session. The Pacific session is followed by the Tokyo or Asia session. Currency pairs that include the dollar, the euro, the yen, the AUD, which is the Aussie, are traded actively during this period. The trading activity of the Aussie, that's the Australian dollar, is caused by the intersection of the working time of this session with the Pacific one. And the third one is the London session. The opening of the European session starts in financial centers such as those in Frankfurt, Zurich, Paris. However, trading gets more active only after trading starts in London. A fairly strong volatility may be noticed during this session because the European zone has sufficiently large amount of money turnover. Then the fourth one would be the New York session, which is the most active time on the forex exchange market. And it's the beginning of the American session because it reaches the opening of trading in New York and the renewal of trading in Europe. So the fundamental news of special importance are released in the beginning of the American session. So the highest liquidity is when these sessions overlap. So many professional traders consider 1400 hours GMT to be the finest time as London is preparing to close and traders are getting ready to move to New York markets. The, this creates big swings in the currency prices, thus opening greater opportunities for profits. But one must be careful as in the very end of the London session, the movements can become a bit quite choppy and harder to predict. So next we get a look at the currency quotation. Oh, sorry, those are the market session times, like when the Sydney time starts uh, from April to October, and also the winter time. I don't really focus on this at this moment because we just want to go through the basics. So we're gonna look at the currency quotation now. So we have what we call the base quote currency. So in Forex, the base currency represents how much of the quote currency is needed for you to get 1 unit of the base currency. So for instance, if you were looking at the Euro USD currency pair, the euro would be the base currency and the dollar would be the quote currency. So as you can see from the diagram there, the base is always one. In this case, the euro USD, the euro is one. The USD that's equal to 1.0676. So what that entails is every 100 euro
Can
is
we're not following the slides? Perhaps we stood on
sorry.
we are still on the old slide with the sessions. We don't have the slides that you're talking about now of the base currency.
Oh, I'm sorry. So maybe because I'm already on the, are we now on the currency quotation slide? Because that's where I am right now. So maybe there's a delay. I'm sorry. Are we now on the currency quotation? Because I'm already on that slide.
No?
Try and just stop sharing and then reshare again. Just reshare your
Mhm.
slide. Yeah, stop sharing and then
All
reshare
right,
while you're
let
still on
me
that slide.
do it. Okay, let me do that. Oh, okay. I guess so. Aaron, what you're saying is now the currency. Okay, I'm just gonna reshare my slide again.
That's fine. Go ahead.
Thank you for telling me. I'll just keep on going. Are we on the currency quotation slide?
Yeah, I can see the current quotation. Sorry, Tamu, are you seeing the current
So,
quotation slide?
I'm yet to see the current quotation. I don't know whether it's mine alone, but I can't see it. It's actually blank where we are supposed to see you sharing. Let's see.
okay, I think when we were, how about now? Because I also saw when Emmanuel shared his slide, like there was a delay in showing the slide. But if
Okay,
everyone is
it's
on,
coming up now. It's coming up now. I think apologies, Tamu. I think we'll try and share the presentation. So Alvin can continue. Sorry for that. Alvin, you can
yeah, well, I'll just have to share the presentation as well. So as I was saying about the base and port currency, so the base currency represents how much of the port currency is needed for you to get 1 unit of the base currency. For instance, as I was saying, if you're looking at the Euro USD currency pair, the euro would be the base currency and the dollar would be the port currency. So the base is always 1. Now, the example here is if you have 100 euro, it's equivalent to 106 and 76 cents. So I'm going to move forward to the next slide, which I'm going to talk about leverage. Are we all on the slide which entails leverage on the top?
yes.
All right, so I'm going to proceed. So in finance, leverage refers to borrowing money to supplement existing funds for investments in such a way that the potential positive or negative outcome is magnified or enhanced. So leverage is vitally important to your trading activities, since choosing the incorrect leverage could result in larger losses and damage potential profits. So the amount of leverage on your account partly determines the amount of funds you need to put up for a trade. Leverage gives the trader the ability to trade larger amounts of currency with a smaller deposit amount. So, for example, with the $200 deposit, and if you have taken a leverage of 1 as to 500, because it's expressed as a ratio. So if you take a leverage of 1 as to 500, this would allow you to trade up to 10,000 worth of currency. Yet you only have $200 in your account, but you are trading up to 10,000 worth of currency. So I'm going to move on to the next slide, which I'm going to talk about margin. And may you please just confirm with me if you're on the slide.
Yes.
Yes. Okay. So it is this margin is the necessary amount you need to have in your trading account in order to open a relevant transaction, whether you want to buy or sell. So there's also what we call free margin. This would be the available amount of money which can be used to open new positions. So basically, the leverage be 1 over the margin, or margin is equal to 1 over the leverage. So that's just basically what margin is, the necessary amount you need to have in your trading account in order to open and trade. So I'm gonna go on to explain what a pip is. I'm sure we've probably found you hear people saying, um, I made so much money, I had this number of pips, like he has 1,000 pips that he collected from the market. So what a pip stands for is a point in percentage. So pips relate to the smallest price movement any exchange rate can make, and is what we would consider a point for calculating profits and losses. So a pip is usually the last decimal place of a quotation. Most pairs go out to four decimal places, but there are some exceptions like the Japanese yen, which go out to two decimal places. But there are brokers that quote currency pairs beyond the standard four and two decimal places to five and three decimal places. They are quoting fractional pips, which are also called pips. And so that's all about the pips. We'll then dive in, do a deep dive into it when we go into the further chapters, just to explain how you can actually calculate your stop loss if you want to see how many pips you're going to risk for you to take a certain trade. So I'm gonna go on with the next slide, which I'm gonna explain about the bid and the ask price. Are we all on the slide? Should be saying bid or ask on the top.
Yeah. Yeah.
So the bid represents the price at which a trader can sell the base currency. If you remember on the slide that we showed the base and port currency, the base is the currency at the left side. So that's the bid represents the price at which a trader can sell the base currency shown to the left in a currency pair. So for example, in the quote USD JPY or dollar yen, 113.67 stroke 69. The base currency is USD. As we say, it's on the far left. That's the first currency that would be in the currency pair. And the bid price is 113.67, meaning you can sell $1 for 113 Japanese yen, 113.67 Japanese yen. The ask represents the price at which a trader can buy the base currency shown to the left in the currency pair. For example, in the quote USD CHF, which is the dollar Swiss franc, 0.9997 stroke 99. The base currency is USD, the dollar, and the ask price is 0.49, meaning you can buy $1 for 99 Swiss franc. The difference between the two is then called the spread, and that goes to the broker that handles the transaction because they're also doing business. So we're gonna go on the next slide. We're gonna talk about what a lot is. Are we all on the slide that entails what on the top?
Yes.
All right. So a lot is the way to measure the position size or the volume of a trade. So a standard lot size, which is equal to 100,000, causes approximately $10 per pip gain or loss. A medium lot size, which is 10,000, causes an approximately dollar per pip gain or loss. Then a micro lot size which is 1,000 causes an approximately 0.1 pip gain or loss. So this entails about the capital that you would actually have in an account. It helps you determine how much you want to risk on a trade. Using a standard lot size when you have a low capital or the amount of money that you have deposited in an account wouldn't be a wise idea. We'll look at that when we talk about risk management, but I just wanted to explain what a lot size is. It's basically the way to measure the position size or the volume of a trade. So now I'm gonna talk about the pending orders. I believe everyone is now on this slide.
This
Sorry, I didn't quite get that. Sorry.
yes, we're on the slide.
Okay, good. So we have what we call the buy stop. The buy stop orders are useful when the investor believes, for instance, with the help of technical or fundamental analysis, which are strategies that we use in the market to determine which which trade that we want to take. If the market reaches a certain level price, which is above the current levels, then it will go further up. So if you can see the diagram on my left, the buy stop is entered ahead of time to enter long. When we say long, it means we are buying the market. In other words, there's a term also called oh, we are bullish in the market. The market is going up, the price is gaining. So we place a buy stop above the price, and we are anticipating that the price is still going to go up when it reaches that level. So it executes the trade as soon as it's going up, it takes our trade and it continues to go up because we would have done our technical or fundamental analysis with the speculation that the price is going to continue going up. So that's what a buy stop is. We go on to the next pending order that we look at, which is called a sell stop. Just waiting for everyone to be there.
Yeah, you can see it.
Okay, oh good. So the sell stop orders are useful when the investor believes, for instance, with the help of the technical fundamental analysis, that if the market reaches a certain level price which is below the current levels, then it will go further down. So it's basically the opposite of a buy stop. So if you see on the diagram, if you look at the diagram, we will be expecting the price to move lower. We mean that the counter currency is gaining more strength on the base currency. Therefore, a sell stop will be entered ahead of time to enter short. Short meaning we're selling. I'm sure you had what I was mentioning on the buy stop. We talked about going long. Long, it means that you're buying. Here we're talking about entering short, which means you're selling. So a sell stop would be entered ahead of time to enter short if the breakout occurs. So the order will be placed below the price if and price is going down. We're going to look at the next pending order, which is a buy limit. I believe everyone is on the slide. So buy limit, the buy limit orders are useful when the investor believes, with the help of technical and fundamental analysis, that if the market reaches a certain level price, which is below the current levels, then it will tend to go up. We can use the term we call reverse in any case. We are anticipating that the market is going to shift its direction once it reaches at this level. So we place what we call a buy limit. That's the order that we place below price, and the price then goes up once it reaches that lower level. So if you can look at the diagram on the left, it's showing that we set a buy limit at 82 and the price was still at 84. what we were anticipating is the price is going to go down at 82, then it will execute the trade and starts going up. So that's basically what a buy limit is. We got to look at the sell limit, which is the opposite of the buy limit, which is useful when the investor believes that the market reaches a certain level price, which is above the current levels, then it will tend to go down. So this order is placed above price, and then the price then goes down. It's above the price or the currency moves towards that price, then it starts going down. So if you can look at the diagram, we would set that sell limit at 88, yet the current price is at 84. Once the price reaches 88, it executes our trade and then it starts going down. Then we start making money. That we're in profits, we would have left a sell limit in place. So what we're going to look at next is the basic concepts of a trend. So I'm going to start with, sorry, are we all on this basic concepts of trend slide?
Yes.
Yes.
Yes, we are.
All right. So we have three directions of a trend. We have an uptrend, which is made up of ascending peaks, higher highs, and higher lows. Don't worry about those terminologies of higher highs and higher lows. We're going to explain it further when we start talking about technical analysis. But I just want to show you like just an overview of what a trend is. The second one is a downtrend, which is made up of descending peaks. It's going down, lower highs and lower lows. And the third one is a sideways trend. Like it's basically self-explanatory. So we have the consolidation is when the price moves sideways in a horizontal range. And then we have also the three lengths of trend. We have the long-term primary or major trend. So the periodicity of that is more than a year. What we will look at on the charts is the monthly chart. That's the time frame that we concentrate on. And then we have the medium term or intermediate trend. The periodicity of that is 3 weeks to as to many months that you can look at. You go on the weekly chart. And then the third one is the short term or minor trend, which is anything less than 2 or 3 weeks, which we actually just concentrate on the daily chart. Don't worry, I'm gonna dive into this. So an uptrend, we're now on the slide of an uptrend. You can everyone see the diagram on my right?
Yeah.
Okay. So an uptrend line has a positive slope and is formed by connecting two or more low points. This is important. That's why I've underlined it. Like it's formed by connecting two or more low points because you cannot have one line, then you draw, you say, no, no, this is an uptrend. You have to have two or more low points that you have to draw. If you look at the diagram on my right, so the second low must be higher than the first for the line to have a positive slope. Uptrend lines act as support and indicate the net demand. The net demand basically demand less supply is increasing even as the price rises. So a rising price combined with increasing demand is very bullish. What do we mean by bullish? The price is going up. The price is appreciating. We are going, we're in a long market. So it shows a strong determination on the part of the buyers, those that are buying the base currency. So as long as the price remains above the trend line, the uptrend is considered solid and intact. A break below the uptrend line indicates that the net demand has weakened and a change in trend could be imminent. I'm sure as we will be learning about this, the Forex market, where you're going to hear a saying of the trend is your friend because you really need to know where the market is going. So we're gonna look at the downtrend. I believe everyone is on the downtrend slide.
Yes,
A
we are.
downtrend line has a negative slope and is formed by connecting two or more high points. Just the opposite. There we were connecting the low points. Right here we're connecting the high points. So the second high must be lower than the first for the line to have a negative slope. So the downtrend lines act as resistance and indicates that the net supply, which is the supply less demand. On the uptrend, we're talking about the support, and when we're saying it indicates the net demand, which is the demand less supply. So you can see this is just vice versa. So the net demand, the net supply, which is the supply less demand, is increasing even as the price declines. And declining price combined with increasing supply is very bearish. What do we mean by bearish? The market is selling, and it shows that the strong resolve, like the strong resolve of the sellers, they use a strong resolve of the sellers. As long as the price remains below the downtrend line, the downtrend is solid and intact. So whenever now there's a break above the downtrend line, it indicates that the net supply is decreasing or weakening. So there might be a change in trade that could be imminent. So if you can see, that's Amazon, a nice downtrend going downwards, but then you can see it then changed. That's when we know that there's a trend, like there's a change in the trend. You would just have to make an analysis. You're now, if you were bearish or you were selling the market, you are now exiting the market, taking your profits. That's why we'll always have those targets. When we talk about risk management, I'll tell you all about it, the stop loss and the take profits. Now we're going to talk about the consolidation or the sideways trend. This is used in technical analysis to describe the movement of an asset's price within a well-defined pattern of trading levels. So if you can look at the diagram on your right, those two lines, the upper one, that's what we call the resistance. The lower one is the support. So consolidation is generally regarded as a period of indecision, like which ends when the price of the asset moves above or below the prices in the trading pattern. So the upper and the lower bounds of the asset's price create the levels of resistance and support within the consolidations. So a resistance level is at the top end of the price pattern, while the support level is the lower end of the pattern. I would simply put it in terms like if it's the resistance, you're just gonna give it an example of a ceiling, and then if it's the support, that's the floor. So once the price of the asset breaks through the identified areas of support or resistance, volatility quickly increases. The indecision is done. We now have the direction where the market is going. So does the opportunity for the short-term traders to generate a profit because you now know if it breaks from the lower, you're gonna be selling the market. If it breaks to the above, you're gonna be buying the market. In this case, the short-term traders who were bullish or who were looking to buy would have made money because it's the price broke above the resistance. Now just gonna explain briefly about support and resistance. So the support and resistance represent key junctures where the forces of supply and demand meet. In the financial markets, prices are driven by excessive supply down. That's what we're talking about, and demand up. So supply is synonymous with bearish. So whenever we talk about supply, we're going to think about bearish. We're going to think about the bears. We're going to think about selling. That's what we're associating with. We are talking about selling the market. Then the demand is synonymous with bullish, bulls, and buying. We have the buyers controlling the market. That's what they fall in. So it's bears and bulls. As demand increases, prices advance, and as supply increases, prices decline. I'm going to repeat that again. As demand increases, the prices advance. They appreciate. It means you're buying. And then as the supply increases, prices decline. Therefore, we are going to be selling the market. So when supply and demand are equal, prices move sideways. That's the consolidation or the sideways trend that we're talking about. As bulls and bears or buyers and sellers slug it out for control to see who is going to be controlling the market at that particular point in time. So the last thing I'm going to look at would be the multi-time frame analysis. I'm just going to quickly go a little bit deeper on the support before I look at the last part of the multi-time frame analysis. So support is the price level at which demand is thought to be strong enough to prevent the price from declining further. The flow. I just gave an example like that's the flow. We don't expect anything to go down there. So the logic dictates that as the price declines towards support and gets cheaper, buyers become more inclined to buy and sellers become less inclined to sell. So if you can look at the diagram on the bottom left, those arrows are showing at points whereby the price was coming back to the support. Therefore, it was coming at a lower price, then the buyers would buy it, goes back up, it comes back down again at the support, then they take another trade. So these are also ways you can identify potential trades when you want to trade in the forex market. These are the types of analysis that you'll be looking at. So support does not always hold and a break below supports signals that the bears have worn out over the bulls because it can break the support. So a decline below the support indicates a new willingness to sell. So in any case, you would be exiting. If you're in a buy position, the support is broke, then you are exiting the market. You are gonna enter. It's either it's a sell, but then I would advise you would wait to see whether if it's going to be going in that direction. But then when the support is broken, new lows signals that sellers have reduced their expectations and they're willing to sell at even lower prices. So in addition, the buyers could not be coerced into buying until prices decline below support or below the previous low. Once support is broken, another support level will have to be established at a lower level. So looking at resistance, this is the price level at which selling is touched enough to prevent the price from rising further. So this dictates that as the price advances towards the resistance, sellers become more inclined to sell and buyers become less inclined to buy. So if we can look at the diagram on our left bottom corner, you can see that was the price pushing towards the resistance level, but then coming back down again. Then it goes up to the resistance level, then it comes back down again. So resistance does not always hold. And when it breaks above the resistance, it signals that the bulls have worn out over the bears. So a break above resistance shows a new willingness to buy and a lack of incentive to sell. So when the resistance break and new highs will indicate that buyers have increased their expectations and are willing to buy at even higher prices. So in addition, the sellers will not be coerced into selling until prices rise above resistance or above the previous high. So once resistance is broken, another resistance level will have to be established at a higher level. So this is the last thing that I'm going to talk about just to cover on the first three chapters that you were just looking at. So what is multiple time frame analysis? So the multiple time frame analysis involves monitoring the same currency pair across different frequencies. So typically using three different periods of time gives a broad enough reading on the market. This is us just trying to have a read, to understand more, to get more information before we can take a trade. So using fewer than three different periods can result in a considerable loss of data, while using more typically provides a redundant analysis. So when choosing the three-time frequencies, a simple strategy can be is to follow a rule of four. What do I mean by that? This means that a medium-term period should first be determined and it should represent a standard as to how long the average trade is held. From there, a shorter term time frame should be chosen, and it should be at least a quarter of the intermediate period. For example, if you go on a 15-minute chart for the short term time frame, and 60-minute chart of the medium or intermediate time frame, through the same calculation, the long-term time frame should be at least four times greater than the intermediate one. So keeping with the previous example, the 240 minutes, which is the 4-hour chart, would round out the three time frequencies, where you would have the 15-minute time frame, then the 1 hour time frame, then the 4-hour time frame. Those would be the three time frames that we would be concentrating on. Moving on forward, what do we mean by a long-term time frame? By looking at the long-term time frame, the dominant trend is established. So the largest time frame we consider is our main trend. This shows us the bigger picture of the pair or the currency pair that we would want to trade. So the positions should not be executed on this wide angled chart, but the trades that are taken should be in the same direction as this frequency's trend is heading. So this doesn't mean that the trades can't be taken against the larger trend, but that those that will likely have a lower probability of success, and the profit target should be smaller than if it was heading in the direction of the overall trend. Going on to the mid-term time frame, this is what we normally look at after we have checked the long-term time frame. So it signals us the medium-term buy or selling bias, like what is happening like in the medium-term time frame. Like what's the bias? Is it buying? Is it selling? So this is the most versatile of the three frequencies, which is the one which is in the middle, because a sense of both the short term and the longer term timeframes can be obtained from this level. As a matter of fact, this level should be the most frequently followed chart when planning a trade while the trade is on and as the position nears either its profit target or stop loss. And then when we want to take an entry, we look at the short term time frame because trades should be executed on the short term time frame. As the smaller fluctuations in price action become clearer, a trader is better able to pick an attractive entry for a position whose direction has already been defined by the higher frequency charts. So the smallest time frame shows the short-term trend and helps us find a really good entry and exit point. I can assure you most traders, even the advanced ones, some would take this into consideration, but the time frame, if you can consider these three time frames, you would be on your way to making very good analysis, getting better, higher probability trades. So putting it all together, when all three time frames are combined, to evaluate a currency pair, a trader will easily improve the odds of success for a trade, regardless of other rules applied for a strategy. This alone lowers risk as there is a higher probability that price action will eventually continue on the longer trend. Another clear benefit from incorporating multiple time frames into another analyzing trades is the ability to identify support and resistance readings as well as strong entry and exit levels. I'm just going to give like a valid example to what I was explaining about that multi time frame analysis. So we're going to take, for instance, John likes trading. This is the Euro USD pair the most and feels most comfortable looking at the 1 hour chart. So he clearly thinks that the 15-minute charts are too fast, while the 4 hour charts take too long. So the first thing that John does is move to check out the 4 hour chart of Euro USD. That's the diagram or the that's been shown like above. So this will help him determine the overall trend. So when we talked about an uptrend, we said it should be able to touch to connect one, like two or more points. As you can see, those are like 3 points connected. So it shows that this is an uptrend. So this signals John that he should only be looking for what? Buy signals. Moving on forward, he then now zooms back into his preferred time frame, which is the 1 hour. He's coming from the 4 hour, now is in the 1 hour to help him support an entry since he likes trading in the 1 hour. He also decides to pop on. Please don't worry about the stochastic indicator. We have a whole chapter on the indicators one can use in order to enhance your technical analysis. So please don't worry about that stochastic crossover that you're seeing. So once he goes back down to the 1 hour charts, John sees that there's a doji candlestick. We're also going to look at the types of candlesticks that we can look forward to if we're looking at the vessel pattern or vessel candlestick. So John sees that there's a doji candlestick which is formed and the stochastic has just crossed over out of oversold conditions. Please just bear in mind, John is an advanced trader. He knows about this, but we're gonna get there. So when he sees that, he goes to the 15-minute time frame. That's the three times that we're saying we should look at when you want to take a trade. So John still isn't quite sure. He wants to make sure he has a really good entry point, and we say there's no better time frame to look for a very good entry or exit point than the shorter time frame. So he scales down to the 15-minute chart to help him find an even better entry and giving more confirmation, or as we would like to call it, confluence. So now John is locking his eyes in on the 15-minute chart and he sees that the trend line seems to be holding pretty strongly. That trend line, that's also the support. Not only that, but the stochastic is showing oversized conditions on the 15-minute time frame as well. So he will take a buy in that case. So as it turns out, the uptrend continues and the euro dollar continues to rise up the charts. There is obviously a limit to how many time frames you can study because you do not want a screen full of charts telling you different things. So you can use at least two, but not more than three. So at least 3 to 2 time frames that you can look at, and they can help you make a decision on which trade to take. So just to conclude, using the multiple time frame analysis can drastically improve the odds of making a successful trade. It is a simple way to ensure that a position benefits from the direction of the underlying trend. So things that we can actually just would need to remember on this part is you have to decide which time frame works well for you. So this comes from trying different time frames, results, because we're going to talk about a trading journal. A trader should always have a trading journal and analyzing those results to find what works for you.
Sorry, Alvin, are you talking? It seems like we can't hear anything.
Short based on the direction of the trend.
Sorry, Alvin.
Then we carry
Yeah, could you come again? I think your mic just went silent for a bit. Maybe you could repeat the
Okay.
last thing.
All right. So uh, I'm just gonna repeat on the things to remember. If we're on the same slide, yes.
Yes, just repeat. Thanks to remember that.
So I was saying the things that we would really like to remember on this part is you have to decide which time frame works well for you, because this comes from trying different time frames out through different market environments, also recording your results, which you would be having to take note of the trading journal, because every trader should actually have a trading journal where you can write your results. Whenever you take a trade, you record if you made a loss, you made a profit, in what conditions, and then analyzing those results to find what works for you in something that we call back testing. So once you find your preferred time frame, you go up to the next higher time frame. Then to make a strategic decision to go long or short based on the direction of the trend. So you then return to your preferred time frame or lower to make a tactical decision about where to enter and exit, meaning where you have to place your stops and profit target. But in this case, when I gave an example about John, he loves looking at the 1 hour chart time frame, but he actually first went to the 4 hour time frame to check on the trend. Then he saw it was an uptrend. He came back to the 1 hour just to confirm further. Then he had to go to the 15-minute time frame in order to find an entry to get into the market, to get a better entry level into the market. So those were the three time frames that he utilized in order to make a decision in taking the trade that he ended up actually taking. So just on the conclusion part, like adding the dimension of time to your analysis gives you an edge over the other tunnel vision of forex traders who would only trade off on only one time frame. So you have to make it a habit to look at multiple time frames when trading. So you have to make sure you practice. You don't want to get caught up in the heat of trading, not knowing where the time frame pattern is. Of course, we're gonna also show like the MetaTrader 5 is there. Those who actually haven't opened in the MetaTrader 5 before MetaTrader 4, I'm gonna show you when we reach to those chapters. But then you have to make sure you know how to shift quickly between those time frames. So you choose a set of time frames that you're going to watch and only concentrate on those time frames. You learn all you can about how the market works during those time frames. As I say, you don't have to look at too many, because more than three time frames tends to be tedious and you'll be overloaded with too much information, and hence your brain might explode and you end up with a messy desk. So you have to stick to 2 or 3 time frames. Any more than that provides to be an overkill. So I think that'll be that. Any feedback is welcome. So the greats, one of the greats in the markets called Paul Tudor Jones. He's a billionaire, an American billionaire, a hedge fund manager. He knows the markets. He once said the secret to being successful from a trading perspective is to have an indefatigable and an undying and unquenchable thirst for information and knowledge. I think that'll be all from me today. If there are any questions, I'm more than happy to answer them. Right, thank you so much for having me.
Thanks a lot, Alvin, for the basics. And then for those for the attendees, as I mentioned earlier, this is going to be a series. So this is just the first chapters that you was looking at in terms of just giving you the terminology. We're then going to get your emails, and we're going to send a notification and reminders to you of when it's going to then take you through the next chapter. As mentioned, that is also going to show us how to open the different positions, how to take a position, and how to do that technical analysis. And definitely on your emails, we're also going to share the slides. We're also going to record, as you can see, we're recording this. We'll also try and break down the videos and then also share them with you so that you can refer back to some of the videos as well as the slides also. Are there any questions? If you've got any question for this basic introduction part or the previous part where Emmanuel had given us a presentation, you can just raise your hand and we can try to answer them the best we can. Yes, Ellen, you can go ahead. Sorry, Ellen, you're on mute. You can unmute your mic and go ahead and ask your question.
You know, if I have been given, go ahead to speak.
Yes, you can go ahead.
Okay. Sorry, I joined late this session. I don't know if, firstly, I would say it was a fruitful one. Thank you for this session. I don't know if you are going to avail this PowerPoint or an audio so that we can record the session again, maybe to grasp some concepts which were shared in this session. Thank you.
Thank you for the question. Yes, definitely. We are going to share the slide as well as the video. We're just going to bundle it up and share it as well. We'll send this to your emails, the emails that you use to register for the platform. We'll send you all the material via those emails. So, Rutendo, you can go ahead. All right, Mando. Rutendo, you're on mute. I see your hand is up. You can go ahead and ask the question. If you're unable to unmute your mic, you can go ahead and type the question in the chat.
Hello, I just want to ask a question. What site do we use to view to do the trading? Unfortunately, I joined in late.
That's okay. The site that you use is VCG. Emmanuel, if you're on the call, can you share your screen and share the sites that they can go to register on the platform? So Emmanuel is sharing his screen.
No
and
problem.
You see the landing page there.
No problem. Let me share my screen right now.
Okay,
Hello.
thank you.
Hello.
Yes, you can go ahead.
Yes, I wanted to ask. Can I use Meta 5?
Yes,
Yes, you
that's
can
the
use
app.
MetaTrader 5. Yes.
Okay, I link it with this account.
So what happens is you register on the VCG platform, you follow the steps, and then when you finish registering, it then gives you the Meta 5 platform, and then you can continue trading from there.
Okay.
Yes, you're welcome.
Yes, I hope you can see my screen.
Yes, yes, we can see your screen.
Yes, so you can go to our website. I do recall that the question was, how can you view trades? Was it correct?
Yes.
All right, so if you want to view trades, once you have created an account with us, you would have to download the MetaTrader 5 app and then link your either demo account or live account to your MetaTrader, and then you'll be able to view the trades. Let me see if it's possible for me to share my phone. I think that would be easier.
Okay, that's fine. While you're sharing your phone, I think Kudzai Modesta has got a question. You can go ahead.
All right, thank you. So maybe I would like to know the difference between the first presentation, which was on VCG markets, and this one. On the first presentation, the presenter took us through their website or the platform where we could see traders who were trading on our behalves. Am I right? Or and then in this scenario, are we the one that will be
So
trading?
essentially,
Yeah.
it's not trading on your behalf. Um, yeah. So
Sorry,
on copy trading,
sorry.
just to correct you on that one, it's not trading on your behalf. These traders are trading their own accounts. They're trading for themselves. What you are essentially doing is just copying what they are doing. So it would be unwise to look at it as account management when they're not trading for you, but trading for themselves.
Oh, okay, it's clear now.
And then to
Yes.
answer the other part, maybe is just simply saying the first presentation was the broker who you'll be using. So this is a licensed broker. And again, this broker, whenever you open a position, you open an account with BCG Zimbabwe and you deposit your funds and then you start to trade. This broker is then mandated to put a certain amount in their collateral account so that just in case if things go wrong and you win and they cannot give you your money, we will then collect the money in that collateral account and then give it to you. So the first presentation was the broker just explaining how to register and what their role is. And then the second presentation is us trying to give you assistance or help you in trying to understand the forex trading market through different series. So at least you start with the baby steps until you be able to walk on the ball. That's the difference between the two presentations. I hope that answers you.
Yes, thank you.
I see Menlo is your hand for the last time or it's a new hand?
Oh, sorry. No, no.
Okay, that's fine. Yes, I see there's a question saying, sorry, I attended late. Is it possible to share the recording? Yes, we'll definitely share the recording on your email.
Okay, I hope you can see my screen.
Yes, yes, we can see your screen. And this video that is showing, we'll also share this video of the how you'll be seeing your MetaTrader on your phone.
Yes, so once you link your account, this is what your MetaTrader will look like. So you'll be able to choose any trading pair of your choice. On the quotes, which is the watch list, there'll be sort of like a default watch list that's there. So you can always edit it and add the pairs that you'd like to trade. So for instance, I can go for, let's say, Tesla. Click on that, come back. And then you will be able to trade your any product of your choice. I don't know if I answered the question that was asked earlier.
I think that was Alan. I hope this view will give you an idea of the MetaTrader. But definitely don't worry. Alvin will take us through this. So if it's a bit intimidating, yes, it is. We know that. So in the next sessions to come, I'll take you through this process of how to then open a position, close a position, do the buy stops, that it's the stop loss rather, and then everything else that is explaining. So you'll be able to look at the leverage and then see the amount that you'll be putting, and then you can then also see the pips that he was trying to explain as well. So he'll take you through the practical presentation of how to then maneuver around your MetaTrader application as well. So those will be the next sessions to come. Are there any other questions? I see, Kudzai, you still have a hand up. Is it an old hand or it's a new question?
Oh, sorry, it's an old hand.
That's okay. Are there any other questions? All right, so this juncture, I'd just like to thank the presenters, as well as thank you, the attendees, for coming. We will definitely continuously share by your email, as well as the other channels that we also used to share this training, to communicate the next steps in terms of the next chapters that will come. So if you then take a look at the flyers that will be given out, of the emails, we'll then be informing you if it's going to be the continuation of this one, or if it's going to be a repeat of this session. You can go ahead, Tamu. I see your hands up. Tamu, if you've got a question, you can go ahead. If you're talking, your mic is muted. If you're unable to unmute your mic, you can type in the chat box. You almost unmuted there. You clicked once and then it went muted.
Okay, sorry, I was in the process of trying to register on the website, right, for signing in. But when I got to the page where it says enter a 6-digit code sent to your phone, it's not coming to my phone. I don't know what's going on.
Emmanuel, that one is yours.
Ale?
Yes, no problem. So it could be a system network failure we're having on our end, but what you can essentially do, just skip on that verification code process for now, and then go to the following steps. Once your account is created, we'll then link it to your mobile number manually if it's not sending you the code.
Okay, so the mobile number that I'm linking, say I would want to use EcoCash, and I've put in a mobile number for Net1. Would that be able to operationalize itself?
No, it won't affect the overall process, because right now, by creating an account, you're just saying that in the event that someone tries to hack your account, you'll be getting notifications on that number that would have registered. But as for deposits, that's an entirely separate case. It's sort of like you're with EcoCash. It's sort of like you're giving us your banking details.
Okay, I know that's fine.
Yes.
So in the meantime, I would have to abort, right?
Yes, so just skip on the verification code process. Just skip on that. You'll be able to complete the other steps that follow.
Okay, I can skip that.
Yes, you can. You can click on the verify later.
Or verify later. No, that's fine. It's okay.
Yes.
Thank you.
Okay. Thank you so much.
And then, Emmanuel, do you have your support number? Maybe you could share your support WhatsApp on the chat, so that those who are then going to be registering, they can then just type up, send you a WhatsApp if they're facing any challenges, just like WhatsApp was just going through.
No problem. So I'm having one of our team members just to put in all the numbers of all the VCG members, so that you can reach out to any of our members and they'll be able to assist you.
Okay, great. That's okay. Are there any questions? Has anyone got any questions? Okay, that's fine. So as my Hooker team is typing in the numbers, just wait for them to paste to copy and paste the numbers there so that you can have those numbers. While we wait, Emmanuel, are there, Alvin or Emmanuel, are there any last words you just like to tell the trainees?
Can everyone hear me?
Yes, we can hear you.
Yeah. So I just wanted to let the attendee here know that it might seem a bit overwhelming, but this is an exciting journey that we're going to embark on. And what we're going to try and do is create a community where we make good money together. So we're going to follow through each and every fundamentals that we would actually have done to look at, because when you are going to take the trades, when you know the know-how of operating your MetaTrader 5, or how to open the trade, or your first profit, you're gonna feel like that achievement. So I just want you to be positive, to be in that um learning like mood whereby you know exactly that what I'm learning is just gonna be able to give me like good good money in the near future. So I just want to encourage everyone. It can feel a bit overwhelming, but it's also very interesting because you are making money over like 3 or 4.
Thanks for that, Alvin. I see the brokers have shared the contacts in the chat. So for those who then might need assistance or always just have their numbers, you can then copy them there in the chat. So any challenges that you face, you contact them on WhatsApp, and also note that when you're registering, if you stop along the way, the team will then always call you to remind you or to assist you if you faced any challenges. They'll try as much as they can to help you as soon as they can, and they'll be there to even support you in the first steps. So thank you very much, VCG. Thank you very much, Alvin. I think if there aren't any questions, we can go ahead and leave the meeting. I won't leave the meeting, but for those who are still copying, you can then go ahead and copy the numbers, but now you're allowed to leave the meeting. Thank you very much. Have a great day. Cheers.